Okay, we put out some results for the first quarter this morning at 7 o'clock our time, and some few sharp-eyed analysts and press people already picked up one or two items from it, which I'm sure we'll get some questions on later. But if we could start out with slide number 1, which is should be showing now, you'll see that in the first quarter, the way, and we talk about operating earnings at Berkshire, we've explained that many times. This is why we think these figures that we give you are the most descriptive of what's really going on in the business, and take out the wild swings in the market that otherwise just can have us reporting big earnings one quarter and big losses another quarter. We pay no attention to those at Berkshire, but you will see that we had a better than average quarter, and Ajit Jain wants me to point out to everyone that you cannot take the insurance earnings of the first quarter and multiply by 4. It just doesn't work that way in insurance. And while we insure storms around the world, the major storms, for example, that would affect our earnings would be, probably number one would be something that went along that came in at the wrong place from our standpoint, and that just kept going up the East Coast, and that's our number one risk as we evaluate things. But we're in all kinds of risks. There can be an earthquake tomorrow. There can be an earthquake 10 years from now, and there can, we're in that sort of business. But the first quarter does hit the. Should be our best quarter. Certainly shouldn't be our worst quarter. The most likely quarter to be the worst quarter is the third quarter. But anything can happen in insurance. But fortunately, nothing much happened in insurance during the first quarter. So we had much improved earnings in insurance underwriting, and then our investment income was almost bound to, well, it was almost certain to increase. And I said that in the annual report because yields are so much higher than they were last year, and we have a lot of fixed short-term investments that are very responsive to the changes in interest rates. So that figure is up substantially, and I can predict that one will be up for the year. We've got more money to invest, as we'll get to in a minute, and that's fairly predictable. So that number will be up. When you get into the railroad earnings, we're down modestly, but we should, not immediately, but we should be earning somewhat more money than we are earning under present traffic conditions, and then traffic conditions can also hit the it's a potential earnings of the railroad. And if you want, every Wednesday you can get car loadings from the previous week, and I'll regard you as a little deranged if you do get them, but I get them every week. They're available, and you'll see that car loadings have been running, for the industry, have been running down modestly, and these earnings were as is expected, but we should earn somewhat more money than that on the equivalent amount of car loadings. And we in the energy company, we had better earnings, but our earnings were distorted. Well, they were affected by conditions that I wrote about in the annual report, and we'll undoubtedly discuss more this morning. But off a low base of last year, they were up somewhat, and so you get down to the final figure, and $11.2 billion is it's quite an improvement from last year. But we would expect our earnings should go up modestly from year to year because, after all, we're retaining like $37 billion last year of earnings. So if we put $37 billion more, you left it with us, we should do something that's satisfactory. And the goal of Berkshire, economic goal, is to increase the operating earnings and decrease the shares outstanding. It's that simple to describe. It's not quite so simple to pull off necessarily, but that's what we're attempting to do. And if we'll turn to slide 2, please. We've got the history, and I just picked the pre-pandemic year of when we hit $24 billion, and then we fell off in the first year of the pandemic, and then, as you see, we've moved up from 27 to 30 to 37 billion. And interesting thing about these earnings is they're after depreciation and amortization and taxes and all that sort of thing. So you can figure that essentially Berkshire has a little over $100 million per day, including weekends and holidays, coming in to deploy. And we've said out many times what we're attempting to deploy that money, but we have that responsibility. And sometimes, if you'll turn to the next page, well, you'll see how that's built up the shareholders' equity, so that Berkshire had at March 31st $574 billion, and through retaining earnings, and we've been retaining earnings ever since we took control of Berkshire Hathaway, except one day, as I remember, I think it was maybe 1968 or 9, the directors declared a 10-cent a share dividend, and I think I must have been in the restroom or something at the time. So if you leave out that period of madness, we've been retaining earnings. We've been saving your money, putting it to work, and sometimes we've done things that were big mistakes, but we never get close to fatal mistakes. And every now and then we do something that really works. And as Charlie had pointed out in the past, there's probably been a half a dozen to a dozen, over 57 or 58 or whatever it would be, really important big decisions, and there's been nothing close to fatal. So that continues to be the guideline, and we have accumulated $571 billion, and I couldn't help but look at who's second, and J.P. Morgan at $327 billion at year end, and they're up to $338, I believe, at the end of the quarter. But they pay significant dividends. They repurchase shares. They've got a business that earns better returns on equity, but they don't plow it, and they shouldn't. They don't plow it back exactly like we have. And this does show what can be done, really without any miracles, if you save money over time. And we have a group of shareholders. We had a group of partners originally, Charlie and I did, that wanted to save money and left their money with, like in that film you saw Eddie and Dorothy Davis, and the Davis family and the children and the grandchildren periodically did some other things with the money, but they also basically left it with us, and we were a savings vehicle, and they were able to live very well, but they weren't trying to live like the kings and queens of earlier capitalism, and used to build the houses in New England, and have a servant but standing behind everybody eating and all that sort of thing. So we've had very few what I would call look at me type people that are attracted to. There's nothing wrong with it, but they just go someplace else, and they are spending sort of unbelievable sums after a while by the standards of the past. And our people, we have nobody that's a miser or a hoarder or anything like that in our group. They live very well. But the math of compounding and a long runway have done wonders, and we will talk a little later. Before lunch, we'll give an illustration of that, of what can be done with that sort of philosophy. Our cash and treasury bills were $182 billion at the quarter end, and I think it's a fair assumption that they probably be about $200 billion at the end of this quarter. We'd love to spend it, but we won't spend it unless we think we're doing something that has very little risk and can make us a lot of money. And our stock is at a level where it adds slightly to value when we buy in shares, but we would really buy it in a big way, except you can't buy it in a big way because people don't want to sell it in a big way. But for certain market conditions, we could deploy quite a bit of money in repurchases. And as you'll see on the final slide, we have bought in the last 5 years. We can't buy it in like a great many other companies because it just doesn't trade that way. The volume isn't the same because we have investors, and the investors, the people in this room really, they don't think about selling. They probably, I would hope many of you don't even check the price daily or weekly. People who check the price daily have not made the money that the people who've forgotten about it basically have over the years. That's sort of the story of Berkshire. We'll try to increase operating earnings, and we will try to reduce shares when it makes sense to do so, and we will hope for an occasional big opportunity. And we're quite satisfied with the position we're in. So with that background, I think we'll turn it over to Becky Quick, and we will alternate questions between Becky and those of you in the audience.